Okay, let's dive right into this. Welcome to today's Explainer, where we are mapping out what I can really only describe as a massive tectonic shift in the digital asset space. We are officially moving away from that era dominated by high-stakes geopolitical relief, and we are stepping firmly into a brand new utility and access regime. Right now, as we sit here in May 2026, Bitcoin is hovering right around its $78,500 true market mean, really just testing our nerves. But listen, if you look beneath that kind of boring, range-bound surface price, the entire plumbing of global finance is being radically upgraded for a new era of infrastructure and integrity. We're seeing things we have literally never seen before, and that's exactly what we're going to break down for you today.
So, here is our roadmap for the Explainer. We'll start with the institutional absorption phase, move into the crackdown on debanking, explore the Layer 1 utility war, witness the agent economy emerging, and finally, we'll confront the looming quantum threat.
All right, Part 1, the institutional absorption phase. $112 billion. Let that sink in for a second. That is the current level of Coinbase advanced reserves. It represents the absolute highest liquidity we've seen since the massive peak of 2021. You guys, this isn't retail stimulus checks we're talking about here. This is a massive influx of professional trust. It's a flashing green signal that deep-pocketed capital is actively entering and parking itself in the market, establishing a rock-solid foundation that we simply didn't have in previous cycles.
We're watching a historic changing of the guard play out. The old era, well, that was characterized by exhausted retail investors, the folks who unfortunately tend to buy the top and panic sell the bottom. But this new era is defined by professional, smart money capital absorbing that supply. And honestly, this is exactly why the broader market is holding so remarkably steady right now, despite what feels like stagnant price action. The smart money isn't leaving, they are accumulating.
But capital is really only half the story. To completely unblock this industry, regulators are actually stepping in. Let's look at Part 2, cracking down on debanking.
Now, what's really interesting here is the sheer scale of the targets the Federal Trade Commission is taking aim at. We are talking about formal warnings issued to absolute titans: Visa, MasterCard, PayPal, and Stripe. The FTC is actively investigating allegations that these payment processors are arbitrarily shaking up U.S. financial access and discriminating against crypto flows. For years, this debanking tactic has been the primary bottleneck, absolutely choking off retail on-ramping and isolating crypto-linked companies. If the FTC successfully forces these giants to stop discriminating, it establishes a brand new legal floor for crypto-to-fiat merchant access. I mean, this is a total game-changer for market integrity.
And hey, this push for integrity isn't just happening at the corporate and regulatory levels, it extends all the way down to the hardware in your actual pocket. Following those terrifying recent reports of tampered, fake ledger devices found in the wild, Satochip is aggressively launching its open-source, non-custodial hardware wallets right here in the US. This is a direct, immediate response to protect everyday investors. It proves that the demand for transparent, verifiable security is higher than ever in this new regime.
So with institutional capital flowing in and major bottlenecks clearing out, the stage is set for an epic battle. Part 3. The Layer 1 utility war. Milestones are rapidly firing off across these networks as they absolutely fight for enterprise relevance. Take Ripple. They are drastically diversifying their utility by pioneering South Korea's first tokenized government bond settlement directly on the XRP Ledger. Pretty wild, right? But actually, scratch that, it's not all smooth sailing. Over in Japan, Ripple's RLUSD stablecoin is hitting a massive adoption wall simply because traditional megabanks still hold the lion's share of institutional trust there. Meanwhile, the Cardano ecosystem is refusing to be left behind. They just proposed a massive critical integrations budget to aggressively fund cross-chain infrastructure and partnerships to close the utility gap with rivals like Solana.
So the crucial point is this. The Layer 1 war in 2026 has completely evolved. In the past, it was all about who had the highest transactions per second, right? The war for speed. But today, nobody cares about speed alone anymore. Today, it is strictly the war for sovereign and enterprise adoption. The winners of this cycle are going to be the networks that can integrate directly with national debts, power central bank operations, and seamlessly connect to critical global infrastructure.
Okay, I need you to speed up your thinking with me here, because while humans are building the infrastructure, machines are already trading on it. Part 4. The agent economy emerges.
$28 trillion. Seriously, trillion with a T. That is the staggering volume currently flowing through the crypto agent economy. Now, to be perfectly grounded about this, about 76% of this is currently just automated bots frantically shuffling stablecoins back and forth to each other. But make absolutely no mistake, this represents a massive paradigm shift.
We are literally witnessing the first truly autonomous financial ecosystem taking shape in real time. Think about TRON, which recently integrated deBridge's MCP server. This is essentially a powerful digital bridge that allows different networks to finally talk to each other. By doing this, historically fragmented blockchains become one unified, seamless execution layer. It's like a giant puzzle finally coming together. What does that mean for us? It means autonomous AI agents can now move assets across completely different chains at absolute machine speed. This drastically reduces the market's dependence on clunky, emotion-driven human trading. AI agents are now officially a permanent piece of our financial plumbing.
All right, let's take a breath and drastically slow our pacing down for a moment. Because while we celebrate these incredible advancements, a very real, very dark shadow is looming. Part 5. The quantum threat.
The entire industry is bracing for what's known as Q-Day. That's the theoretical day when quantum computing becomes powerful enough to literally break modern cryptography. The nonprofit group Presidio Bitcoin just released a massive readiness paper on this exact subject. And what's fascinating, and honestly a bit terrifying, is that analysts believe we won't see compromised coins moving on-chain first. Instead, the derivatives markets might be the very first place we see a massive quantum sell-off as insiders desperately hedge against the threat.
To understand how seriously this is being taken by the smartest people in the room, listen to what Blockstream CEO and legendary cryptographer Adam Back said, quote, "Bitcoin should prepare for quantum threats now, even if they are currently considered lab experiments. When the actual pioneers of this technology are telling us to prepare today for the science fiction of tomorrow, we need to listen. The threat is officially moving from the whiteboard to reality."
And this brilliantly illustrates an absolute nightmare scenario currently being debated. The BIP 361 migration dilemma. If the network pushes through this proposed upgrade to become quantum resistant, what happens to the millions of Bitcoin just sitting in old, vulnerable legacy wallets? The network essentially faces an impossible choice. Do we forcefully freeze those coins to secure them, effectively violating Bitcoin's core ethos of unseizability, or do we just leave them alone and risk massive quantum theft that could literally crash the entire market? There are no easy answers here, folks.
So with all this macro development swirling around, what is the bottom line for your portfolio? Here are the key takeaways. First, watch closely for Bitcoin to hold that $78,000 level as a new permanent support base. Second, if the FTC investigation yields a positive signal against Visa and MasterCard, that removes the primary bottleneck holding retail back. Third, keep your eyes glued to Cardano's infrastructure integrations and Ripple's sovereign debt moves, because these are the real indicators of the new utility regime. If these pieces align, the sheer scaling volume of the agent economy could very well provide the exact fuel needed to push digital assets toward that highly anticipated $85,000 target.
Which brings us to our final, ultimate question for this explainer. You've seen the data. You've seen the infrastructure being ripped out and replaced. As the very plumbing of global finance is meticulously rebuilt to serve institutional smart money and autonomous AI agents, will your portfolio be properly positioned to survive the quantum leap? It is something every single one of us needs to deeply consider. Thank you so much for joining me for this explainer. Keep your eyes on the data and keep learning.